Let's get some insights on the news shaping the markets. For that, we welcome in Erik Lundh with us, principal economist at the Conference Board. Thank you so much for being with us. Of course, a big week ahead, GDP, PCE. We'll be watching for that on Friday. Your thoughts on what's going on in the economy right now, and what are you watching most closely?
Sure. Thanks for having me, Nicole. I mean, we closed out 2023 on a much stronger footing than I think many people had thought at the beginning of that year. As you mentioned, GDP comes out on Thursday. We're expecting to see a print of about maybe a little bit higher, 2.5% growth, primarily driven by consumption and residential investment. But we have some other, great things happening over the course of the last year as well. Inflation has come down precipitously. We had almost 9% inflation at its peak, and it's down into the threes at this point. We're expecting to continue to see that play out over the course of this year. We're hoping that the Fed hits the 2% target that it looks for sometime by the middle of this year. And as a function of that, we're expecting to see, interest rates finally begin to drop, possibly in about June or so, at a rate of maybe 25 basis points a meeting through the end of the year. So, we're heading into the year on pretty strong footing, but we do have concerns about some of the consumption trends that we saw last year, sort of petering out to a certain extent in 2024, as savings are depleted, as debt continues to rise. So it is something that we're mindful of and that we're a little bit concerned about.
Yeah, understood. I mean, that PCE print on Friday, what are you expecting there?
Well, I mean, it's given the retail sales numbers that we had for December, we are expecting to see some strength in terms of the PCE consumption, top line number there. But on the inflation numbers, we're also expecting to see a little bit of progress in terms of the headline PCE deflator and the core deflator as well. So it'll be a story, I think, of gradual sort of slowing further of the inflation as we get closer to sort of some degree of normalcy, hopefully by the middle of this year.
Right. As we look at the Fed funds futures, as you noted, you're not expecting them to lower rates until June. And that number for March, I've seen everything from 41% to 47%. The whole point is that it's been coming down. I mean, people don't think March is as likely as they did. That being said, is the rate hike still on the table?
I don't think so. I think we've been at terminal, Fed funds for several months at this point. If there's a turn in the economy, if inflation starts to peak up, if the labor market numbers start to come in more tightly, if consumption really takes off again, it's certainly a possibility, but it's not a probability. The higher probability at this point, I think, is the Fed's waiting to see a little bit more cooling off on the inflation numbers, hopefully a little bit more slack in the job market, and then it's going to start to lower those rates. But I think it's important to remember, we're not going to jump out of restrictive territory all at once. Historically, interest rates are still going to be on the high end for quite some time until we get into probably 2025. The neutral rate is not something that we're going to see achieved most likely in 2023.
Yeah, understood. What about what's going on in the housing market? You noted that GDP was going to be driven by consumption and non-residential investment. If mortgage rates continue to come lower, the idea here is things will pick up.
Absolutely. I mean, we are forecasting that will happen. We are expecting to see residential investment numbers pick up, not in the beginning of 2024, but maybe a little bit later as 30 years come down. It's going to make housing more affordable for people who are looking to buy. And it's also going to maybe loosen up supply a little bit. A lot of people who potentially are interested in maybe selling their house, but have a fantastic interest rate that they locked in, last year or the year before, they're going to be waiting for rates to come down a little bit before maybe they're willing to sell and then take out a new mortgage to buy a new house.
Yeah, understood. Last but not least, tell me your thoughts on the consumer at this point. I just heard a piece of New York news which talked about how many folks are actually going into major debt because of their medical bills. I never really realized that, and I thought it was an interesting tidbit. that being said, people somehow have the freedom and resiliency to keep spending. Erik, your thoughts on where the consumer stands in 2024?
That's been something that we've been concerned about, to be perfectly frank. The consumer has been spending fairly rapidly, certainly in the second half of the year. Consumption growth outpaced income growth. And as a function of that, we've been seeing debt levels rise. We've been seeing default levels rise as well, and also a depletion in savings. Also, there's stories about the buy now, pay later phenomena. So we're going to see consumers having to sort of reach into their pocketbooks to pay for some of the goods and services maybe that they spent on over the course of the holiday period. And so really moving into maybe the second or the third quarter, we're concerned that the consumer may have to sort of pull back to a certain extent, find their footing again, and we could see spending overall for the economy really sort of peter out, potentially even contract for a quarter or two, which could drive overall GDP into a sort of a correctionary territory. So the consumers really, I think, are key for this year.
Yeah, I just have a quick question because credit card default rates went up to, or credit cards owed over 1.3 trillion. I think that's where we are, and you tell me because you know the numbers the best, but it's my understanding that's the highest ever or whatever. Default rates, you just mentioned it. There was some indication to me that the default rates were similar to that of pre-pandemic. Is the amount owed, the 1.3 trillion, and the default rates similar or more than in the past?
They're approaching basically where they were in 2019 in terms. I think you bring a really interesting point in terms of the 1.3 trillion in credit card debt. We've seen inflation ramp up quite a bit over the last couple of years, and so the 1.3 trillion isn't quite as scary potentially as it first sounds. I think it's important to put it into the context in terms of how much more households are earning as well at this point. So if you look at the ratio for overall credit card debt to income growth over the course of the last couple of years, it kind of takes the bite out of it a little bit. But again, the consumption sort of growth that we've been seeing isn't sustainable. We're approaching sort of these thresholds in terms of where we were in 2019, and there isn't really a lot of additional sort of legroom, if you will, for consumers to lean into the debt and lean onto the savings, which they've already depleted, anymore. There's going to be sort of a correction that's going to have to happen. The consumer is going to have to pull back and sort of find a new normalcy in terms of their ability to spend.
Erik, thank you. Erik Lundh of the Conference Board today. Thank you.